Tim Quast, good morning. How are we doing today?
Happy Market Structure Monday, guys. Good to see you.
I forgot the bushwhackers. I get all sidetracked. There's so much going on. I forgot to bushwhack Tim here. I don't even know if Tim knows who the bushwhackers are. I always do it to him. But were you a wrestling fan when you were a kid?
I was not.
You were not, so you don't know the Bushwhackers.
They were from.
So the background was the WWF, and they were the tag team, the Bushwhackers. They'd always come with their music, and they'd come in like this. I don't know why I started that with your market structure segment, but for some reason I did, and now it's like a habit. And they say after 21 days, something becomes a habit. I think you've been on the show for 21 days now, so now it's a habit for me.
There you go.
Tim, how's it going, buddy?
It's going well, thank you. It's snowing heavily in Steamboat Springs.
Are you still skiing?
We still have awesome conditions. So yeah, the season rolls on. We were out, actually not skiing. We were out because my wife, after 2 ski-related knee surgeries, won't strap on wood anymore, but she loves to snowshoe. So we were out on rabbit ears at 9,500 feet in perfect snow over the weekend.
Nice.
Just great. Wow. Yeah.
Very enjoying yourself. My boy skied for the first time last week there. He's 7 years old, but he enjoyed it. The only problem he had was never really thought about it, but he got sunburned. I mean, you don't think about it when it's like 30, when it's 32 degrees outside. You don't really think about a sunburn, but I mean, the snow, the sun coming off, it was a sunny day. And I'm like, looking at his face at the end of the day, I was like, was he sunburned?
But was he wearing goggles?
Yeah, he was too, but only on down the slopes and stuff, so they're coming on and off. But yeah, so anyways, either way, he did have goggles, but he still got sunburned.
Did you teach him how to pizza and French fry? Pizza, French fry? Right?
It wasn't me teaching him; it was his aunt and his uncle.
Oh,
so.
Okay. All right.
I was actually trying to start.
Tim, we were talking just now about last week's rally and sort of what to think about it. What do you think about it?
And by the way, Boeing, oddly, that is the headlines on Boeing, before I answer your question, Spencer, are, there's a 737-800 that crashed in Southeast China.
Right. So
oddly, that's the news. I think maybe the fact that Boeing is up is it's not a MAX.
Boeing's down $10.
Is it? Okay.
Yeah,
okay.
Boeing is getting hit on this. It was up earlier, obviously, and then this tragedy happened. So it's come back down. So it was down almost $20 at one time. It was down 18 points earlier on. Now it's only down 9, so it's bounced back. So I think it is to your point. I think if this was a MAX, this would be getting hit harder than it is. But because it's not a MAX, I think to your point is, I mean, plane crashes do happen. We don't know the reasons behind it yet, but because it's not a MAX, I think it's maybe it's come back a bit maybe since we got the tragic news.
Yep, and new options trade today. So if you have a pre-market dip like that, it creates an opportunity for a trader in new options. So Spencer, to your to your question about the market last week, once again, I'll say that the turn tends to come during options expirations. I did not hear anybody until Friday even mention the options expiration cycle and how all the things that were the trouble for the market, Ukraine and a Fed rate hike, suddenly became the reasons that the market was surging. The certainty of a rate hike is the reason that stocks are surging.
I hate that. It pisses me off so much.
It's just nuts. That is not the way traders. That's your Market Structure Monday lesson. That is not how the market works. The market is not full of illogical, irrational participants who one day sell something for the same reason that the next day they buy it. That's not the way that the market works.
Well, the media always wants to find the fundamental reason for a move, and they don't want to hear about options. They want to hear about there's a story here, or there's something, or okay, so they're comfortable now with the interest rate picture, and that's why they're in the media. The media will always justify the move with some fundamental reason.
And then what you'll also see is, like, for example, stocks rally after Fed raises rates a quarter point, right? There was nothing false about that statement. Stocks did rally. The Fed did raise rates a quarter point, right? But when you put them together like that, you create this assumption that one caused the other, or the implication that one caused the other when that's not necessarily true. But anyway, keep going on your point.
It's what the mathematicians call a false correlation.
Sure.
And there, you could Google false correlation, and there are hilarious things about false correlations, things that seem to move in synchronicity. But remember, we talked on Market Structure Monday last week about the fact that if tech, in fact, we've been talking about it for 2 weeks, that if tech is going to turn, if a surge is going to come, it will come into options expirations March 18th. It's going to lead into that. And why would that be? Well, because of the way that the market works, and I'll keep this very simple, that there are stocks and derivatives that trade in place of them. And if stocks are discounted relative to the derivative, then the discounted item will become the thing that you buy into expirations. And that was tech. So tech posted some big surges. Now, whether they're sustainable or not with new options trading today, that's what will remain to be seen. And here's something, the last comment on this that I would make is that today, with new options trading, two things will drive the market, and these two things will conflict with each other. And so it'll be interesting. We may have a volatile day, and whether we finish up or down will depend on how these two things sort out. It is the demand for new derivatives that expire in April. Do people come back and buy substitutes and make bets on the market and hedge their positions with derivatives? That's one thing. And then all the stuff that happened last week that resulted in winners and losers, that will sort out. And the two things will determine which way the market goes today. And I don't know. I can tell you what the broad sentiment is doing, that it has bottomed and it's rising. But there are two things that are generally signals of a top, not a bottom, that are present in the market. Again, I look at the data every day. I don't prognosticate. I just take the data as it comes. But short volume market-wide is very high. Look up NSIT, Inside Enterprises. It's 92% short. That you might expect in a small cap. Hewlett Packard is over 80% short. Over 80% of its trading volume is coming from borrowed stock. The levels are very, very high in the market. That's not generally the sign of a market bottom, but a top. And then number two, volatility is very high. It has been over 3% in the market all year in 2022. That's the spread between the average intraday high and intraday low. Those things, high volatility, tends to mark tops, not bottoms. Again, I'm not saying what will happen, but those are some contradictory signals that we see in the data.
I mean, this is, and you're I take a quantitative approach, you take a quantitative approach. I mean, this is, the way, it's a more consistent way of trading, in my opinion, than just discretionary making calls. And a lot of people, will look, we're on a show where we all have opinions on everything. Everybody's got an opinion. But, I've said it before, I make a lot more money from my quantitative approach where I'm not making opinions on stocks than I do from making opinions on stocks. And that's mind-boggling to most people, because they think, oh, you may make an opinion, you've got to come in, you got to buy something. But you're using a systematic approach to the market.
Correct.
You're not really making opinions. You're not really trading your opinions. You're trading that systematic approach.
I only care about supply and demand and context. What is occurring around us at any given moment? There are important things, the beginnings of months, the options expirations period, and the ends of months. The market moves in a monthly and quarterly cadence. And why is that? Well, it goes back to the whole way that money works in the market. If you're running a hedge fund, you're reporting results monthly to your clientele. Well, that's very important. At the beginning of the month and at the end of the month, between those, you have a chance to produce a return. And that's going to affect your behavior. That's trillions of dollars. Then you add in the tens of trillions of dollars that are benchmarked two things.
Yeah.
And it's every quarter you're going to make some adjustments. It might be exposure to the market. You may talk to your clients and say, we're now increasing our exposure to value and decreasing our exposure to growth. We're increasing our exposure to fixed income, decreasing our exposure to that's the stuff that's going on. So you can't, traders, think that all the time, every day, the same stuff is going on. You have to think about the context. So I'm very much focused on supply and demand. And those are measurable things. They're not perfect. There's no perfect system. But I can, in my own accounts, that when I follow the math, and I always outperform the market, period. So there's something to that.
Can you give us maybe some ideas for this week, Tim?
So yes, and here's a great way to look at. Let's take 4 of the top, excluding Nielsen, which you talked about, a deal stock. By the way, you can use Market Structure Edge to look at deal stocks and determine whether these deals have substance or not. If you see heavy short covering, there's a probability that there is merit to a deal. If there isn't, there probably isn't merit to it. But I want to look at 4 things last week that, besides Nielsen, were top performers, and let's look at the supply-demand balance in them. If you like, we can look at Nielsen really quickly here. They reject this takeover bid. So what does the math tell us about? Could we have already known that? Well, so the green part is the demand side. Very good demand. Supply did dip, but it's almost 50%. It's 46% of the trading volume that is borrowed or created. In deal stocks, what we have seen for 15 years doing this is that in deals that will stick, those levels drop to about 30%. So the math was already telling us that, save for the covering by people who were caught out by that, there was a belief this deal isn't going to happen at this level. Now, if the deal is revised by Elliott and its compatriots in this transaction, and we see the levels drop, then it's got merit. But so let's go look at Moderna, big performer last week. Is there merit to supply and demand in Moderna? And what you want to look for is a diverging supply-demand pattern. It's that simple. So here's Moderna's demand, green. This is price, just closing price. Here's the supply side. Well, you have a divergence. Rising demand, relatively flat supply. That's why price moved. But look how high the levels are. 60% of the trading volume in Moderna is artificial. That means if demand stalls, the price will go down. So I would say, no, that was options driven. That was an options driven trade, probably doesn't stick. Look at Etsy, another great performer last week. And Etsy is it's a trader's dream if you're on the right side of it. It's incredibly volatile. It tends to move violently during options expirations and around earnings. So here's the demand side. It's at 1, and the supply side took a dip. That's why it surged. But look, once again, it's 60% short and a 1. I am not buying that. You say, well, then I missed out on all those gains. Well, if you've gotten those gains, take them, because that is not a pattern that lasts. And it's very mathematically consistent. PayPal, another great performer last week. So what happened with PayPal? It's again, I look at the supply-demand equation and say, okay, I can understand why it moved. There was a lot of demand for calls going into options expirations. That's what this big dip tells us. But it also tells me that with demand rising and now supply rising too, it's a lot better than the other two. It is actually the best of the lot because those levels are lower. The run is not going to last again. So you should know that as a trader. Know when you should get out of something, no matter what the charts are telling you.
So on something like PayPal, it's telling you to take the profits from this recent run?
It is. Yep. Yeah. Even though the demand is still rising, I don't like rising supply and demand at the same time. Those will cause the gains to run out of steam. That's what's going to happen.
I'd be curious. Can you look at any one mega cap? I don't care which one. Apple, Amazon, Microsoft.
Yeah, let's take Apple.
Pick one. I want to like to see that right now.
Okay. So here's Apple, and I have a little bit of Apple, but only because I thought all the money was going to come back into tech. into options expirations and index rebalances. It's not great either. It's got the sentiment has just ticked up and supply is flat. That tends to sustain gains. But what if it doesn't ever get back to 5? Apple is spending a lot of time the last 15 days below 5, and that's why it's struggled. It's not bad. I look at Apple and say it's not a bad thing to continue to hold, but it's not. These are not the conditions from a supply-demand standpoint that tend to give you big gains. Interestingly, love, yeah, it is. I mean, if I'm not saying that Southwest is going to surge. I'm just saying this is the kind of condition that produces gains. See this big divergence between demand and supply? Demand rising, supply plunging into new options trading. That tells me there's a lot of demand for derivatives in Southwest. So that can produce a nice move in the stock. Not absolute, but that consistently in the math. We study this all the time. Well, I've got a full-time person on staff who all he does, he's a mathematician out of the University of Kansas who crunches the data like this all the time to look for those conditions. And it works.
All right. If you want to know more, I mean, Tim joins us every single Monday. He also joins us once a week on Benzinga Live. But if that's not enough for you, check out his platform, the one that was on the screen there, Market Structure Edge. The link is up on the screen. Use the code BZFriends20, BZFriends20 to get $20 off your first month. That code's only good if you use it in the next couple of weeks. So do that. Tim, always a pleasure. Thank you for joining us.
Always fun to see you guys.
See you, Tim. Thanks.
All right. Enjoy that skiing.